So you've got to go back to basics, and you've got to think about the actual fundamental drivers of returns in fixed income. They are different from other asset classes. Crucially, they're different to equities, and that's why they still do have a very important role and will have in the future.
Welcome back to Breakout from Breaking Views, sponsored by PGIM. I'm Peter Thal Larsen, the global editor of Reuters Breaking Views, and I'm joined this week by Felix Martin. Hello, Felix.
Hi there, Peter.
Good to have you back. So, Felix, you've been on a mission recently to talk to students about the why they should consider a career in fixed income, in bond investing. Apparently, it was a tough sell. Explain why that was difficult.
And that's exactly right, Peter. Yes, I was lucky enough to be giving a guest lecture last week at a leading business school. Lots of very, very bright MBA students, and it's an elective course which introduces them to asset management. And I was doing the part about fixed income and bond investing. And I mean, the basic reason that it's a tough sell is that it's no secret to anyone that the last 2 years, in particularly, have been a very rough time on global bond markets. There's been, big upswing in inflation, huge hikes in policy rates, big bear steepening, as we call it, in bond yield curves. So the long end bonds selling off even more than the short end bonds, and all of this is causing absolute havoc in bond portfolios. So that's been really sort of painful, and it's given it a bit of a bad reputation, I'd say.
Yeah, and it's sort of challenged the kind of the convention, the main reasons why people talk about the benefits of fixed income, right? So tell me a bit about what those are.
Yeah, that's exactly right. I mean, because as I explained to these students, I mean, traditionally, the role of bonds, fixed income in a portfolio is threefold. I mean, one is to provide positive income, hopefully a nice stable income, and obviously, that looks like a bit of a joke over the last couple of years. We've had the US aggregate bond market registering its worst return, highest negative return since 1871. Another thing is that it's meant to be the more stable in capital terms part of your allocation to sort of balance more risky equities and so on. And you only have to look at some of these famous examples out there. The 100-year euro bond issued by Austria back in 2017, down 75% from its peak valuation, so that doesn't look too stable. And then you've also got this idea, which has always been, this pretty crucial idea in asset allocation, that fixed income bonds should provide ballast in a portfolio against the risky part of the portfolio. In other words, negatively correlated. And again, that has gone up in smoke in the last 18 months because both equities and bonds have sold off at the same time. So they've been positively correlated, and they haven't provided that diversification.
Okay, so yeah, at this point, people are probably leaving the room saying, "That's it. I'm off to hear from the private equity guy or the the infrastructure investor or something." So what was your pitch to say, actually, things aren't as bad as they look? Stick with fixed income.
Well, the case I was making is this: you've got to go back to basics, and you've got to think about the actual fundamental drivers of returns in fixed income. And they are different from other asset classes. Crucially, they're different to equities, and that's why they still do have a very important role and will have in the future. And in fact, this major correction that we've seen may set things up for a much better environment for bond management in the future. So, what are the drivers? Well, of course, crucial underlying driver is interest rate risk. When we're just talking about government bonds, for example. And there, it's just really important to remember, and easy for equity investors to forget, that bonds have a sort of an anchor that equity investors don't. The cash flows are contractual. The income that you're assigned is contractual, and the principal payment at the end is contractual. And that means actually that as sell-offs occur, they do become these risk-free assets. So they call more attractive. Yields go higher and higher, and so bonds in that sense, they don't go to zero. Equities can go to zero. Bonds with credit risk can certainly go to zero, but risk-free government bonds, they don't go to zero. Once things get very stretched, they tend to come back again. So that's the first important thing.
Okay.
Then you've got credit, then if you want to get into credit risk as well, so on top of taking government bond risk, you're taking credit risk by buying the bonds, for example, of companies that can default on their debt. That's a different matter. Credit spreads, valuations, they're not necessarily very attractive at the moment in absolute terms all around the place. That's true. People do make that point. Although there's a good case for saying that relative to equities, they aren't looking too bad now. You've now got investment grade bond yields for the first time in quite a long time, exceeding the earnings yield, for example, on the S&P 500. And that suggests in relative terms, at least, you might want to buy the bonds of companies rather than their equities. And then there are other opportunities out there which actually look quite nice in absolute terms as well. And then if you really want to take some nice risks in fixed income, you can venture internationally, and you can take currency risk as well. And whereas equity investors usually think, currency risk all washes out, so generally, you just buy your international equities and you assume that if the currency strengthens, then it'll probably be reflected in equity prices and vice versa. It's a bit different in fixed income. There's much more of a sort of umbilical cord linking yield differentials to currencies, and so there's a lot more opportunity there. And if you judge by something simple like the Economist's famous Big Mac index, which tries to compare real values of currencies across countries, you'll see that the vast majority of currencies today are cheap to the US dollar. And so maybe that will provide some sort of tailwind in future for fixed income.
Okay, so there's the case for piling into corporate bonds in emerging markets. Felix, well, hopefully, I hope that that your students were somewhat persuaded by your argument, and I guess maybe this is a moment for people who are sort of considering their career, starting their career, to think. Don't look in the rearview mirror. Look at the way things might be in future.
I think that's a great way of putting it. Exactly. You've always got to think forward, and with these big corrections, maybe the past 15 years, which just haven't been a great time. It's not just the past 2, actually, the past 15 years, of course, for fixed income managers have been a bit of a bore because interest rates have been so low. You haven't been able to fund liabilities and so on. Well, all those things, they're changing. They may not be at the end of the change, but they're changing pretty rapidly. So it could be the place to be for the next 10 years.
Okay, well, Felix, hopefully you provided some career advice and also maybe cheered up some people some slightly more grey-haired fixed income investors who are looking for reasons to be cheerful. So thanks very much. Great to talk to you as always, and we'll talk again soon.
Thank you.